Welcome back, Frontier family. Hope you're ready to learn more and earn more. In this episode, we have Eric Grafstrom, the co-founder of ExitGuide, and he's on a mission to revolutionize small business exits. From pioneering webcasting at broadcast.com to navigating the high-stakes world of Silicon Valley startups, Eric has spent over 20 years as an executive, coach, and fractional CXO for venture capital-backed companies. Now, he wants to help the next generation of entrepreneurs structure and prepare their next ventures to ensure they're creating a business and not a liability. So let's get into it. Eric, welcome to the show, man.
It's great to be here, Drew.
Yes, sir. Yes, sir. And I love our previous conversations, right? Because a lot of what we're going to talk about today is, essentially exiting. Not everybody wants to think about, hey, man, I'm starting a business. Why got to worry about, ending the business? Well, hey, but if you think about it now, you may never sell, but you're going to be constantly approaching that structure, making sure that you have something to sell if you have to, versus kind of falling flat on your face. So we're kind of getting ahead of ourselves. There's still some early experience that I definitely want to hit on because it's huge into understanding why you are where you're at, right? So, with that first thing off the bat, what made you want to transfer from that high-level executive seat into kind of starting a new small business service company?
Well, when you say executive at startup, it is not the same as being an executive at a Fortune 1000 companies by any stretch, or a Fortune 10,000 company. So I started my career selling T-shirts, in college, and made enough money to buy a car, and started early at a company that did well. And as you move through this, it's just a difference of taking something that maybe is just an idea or very early stages and turning it into a business. And so I spent decades doing that, and really got a lot out of it. What's different when you do a startup, and I always try to draw this distinction, there's a difference between starting a business versus starting a startup. We'll take a second to explain that. Starting a business is, if you and I wanted to start a coffee shop or an accounting firm or maybe a commercial cleaning company, no one's going to look at us and say, why would you do that? Do people need it? The challenge is marketing, execution, quality of service. Starting a startup means you're effectively taking an idea or a thesis to see if it can become a business. And ExitGuide is a unique blend of taking my experience of working with a lot of startups and then helping a number of businesses, but realizing that there's this kind of gap in the market that technology, I believe, can solve. So we're starting a startup to help businesses that are small Main Street businesses. And it's just a huge gap in the market. We'll talk more about the demographics, but this is a huge part of our economy, and a lot of it is owned by people over the age of 50. So the need is massive. The opportunity is huge, and we think we're ready to take it on.
Absolutely. And was there some time transitioning between the companies that slowly you started to see more of the market developing, right? Because at first, it isn't like there's a ton there, but then when you, as our previous conversations have stated, hey, there's been 5,000 companies that have been through your process. So clearly the market is there. So what was kind of the big, okay, hey, there's something here?
Well, when you look at the numbers, and when I started ExitGuide, I came in with a thesis, and this is before things, I would say the space has drawn a lot of attention. It's become appealing. A lot of, especially folks in younger generation, younger millennials and Gen Z are looking at this saying, do I want to have loyalty to an unloyal corporate entity, or do I want to have something that is maybe more blended into my local community and in something that I own and control? So last couple of years, I was in Silicon Valley. I was helping a lot of distressed companies, venture-backed companies. And it's just a different law of gravity when you're talking about the value of these companies and exiting these companies. And, I'm driving on the road one day and a story comes on the radio about baby boomers trying to figure out how to transition their businesses as they're aging out. See, when you look at the raw numbers, forget about startups. I'm talking about the stuff you see day to day that you interact with. You see the trucks and drivers in your neighborhood, you pass them and you are driving to work and so on and so forth. Small business in the U.S. generates about 40% of our GDP. Now, of those, over 80% are owned by someone over the age of 50. So boomers and Gen X. Now, that in itself is a massive market. When you look online, when you follow stuff on Twitter or YouTube or TikTok, it's okay, I want to buy one of these boring businesses. And that has become a hyper-competitive space. There's one number that really interested me in terms of trying to solve from a technology perspective, and that is, sure, but close to 90% of these businesses, though when we're talking about this massive market, are worth less than $5 million. In fact, most are worth less than $2 million. So it creates this unique opportunity, but a unique set of challenges. The opportunity is, well, We still have a huge portion of these businesses that are going to come onto the market that have, a value north of $5 million. Business brokers, M&A advisors, attorneys, and others, they will obviously be able to help them. And financially, it works. They can make money off of hourly fees and or success fees. But when you're talking about a business that may be worth $300,000, $750,000, or $1 million, well, it just doesn't really work to have somebody, get involved on a very, hands-on basis who's going to charge maybe tens of thousands of dollars. But it's like, close to 90% of the market. So when we looked at this, I said, all right, like how I approach it, someone like LegalZoom approached the market, which is business entity formation is something that every business owner effectively is going to have to do. It doesn't always make sense to sit down and talk to a lawyer who's going to explain the same set of parameters, whether you're starting a rug store or a manufacturing company of LLC, S corp, all that other stuff. So we kind of said, well, when it comes to exiting, a lot of these business owners just need some basic information and support to get through this. And if we show them through an online dashboard how to do some of the basic prep work, they could do some, if not all of it, on their own in terms of packaging the business up, understanding what it's worth, how to navigate due diligence, get the right agreement, and actually get a transaction done. So this is really more about, bringing a process that is is necessary to be more complex as you get into bigger businesses and trying to simplify it through an online dashboard that a business owner can follow either on their own or maybe with the help of a coach or an advisor on a light touch basis to get through this process.
And it's really to that point that dashboard's kind of been condensed into 3 overarching steps, right? A lot of that, the valuation, the collection and preparation, as well as like the final eval of the business, right? And taking that kind of to the market. And so how have you condensed, to your point, such a complex process into really, I know there's more than 3 steps, but into the generic 3 steps of it. And to that point, provided it to a market that kind of has a smaller market cap.
Well, it's a good point. And I go back to what is the problem set, right? So when you're starting a startup, like if you're back to our example, if we're starting a pizza place, no one in their right mind is ever going to say, do people like pizza? They like good pizza, right? But so we started with the problem set. The problem is, about 80% of business owners who try to take their business to market and sell it fail to get a deal done. And there's 2 big points. One is they shoot themselves in the foot when they try to take it to market. It's not priced correctly and they don't know how to package it. So it may be a good business, but they've not used any form of valuation methodology, or they've not packaged this up in a way that's even remotely compelling, even though they might have a good story to present. So that's kind of failure point number 1. Failure point number 2, 50% of deals fall apart in due diligence. And so, when you think about it, most, if not all, these business owners have never done this before. So, this is a massively important transaction, for their business and for their personal life that they're trying to navigate on their own with zero experience or support. So you're going to see a lot of failure rates. When we looked at those 2 things, we said, okay, how do you help people package this correctly and price it correctly? And how do you make sure that they at least are prepared so that they can complete due diligence? Now, if things fall apart because of other dynamics in the business that are beyond our control, that may be the case. But when we looked at where the problem set was, it wasn't actually finding a buyer. Most people, when you talk to them, so we've surveyed a couple thousand, about 20 some odd percent say finding a buyer is their biggest concern. Close to 70% will say, I don't even know where to start or what to do. And so that fear limits them from actually even taking any steps. And so it just runs out of gas, or they settle for something, or they try and they fail. So we said, all right, look, how do we help them where, the failure rate is super high? And how do we simplify these things so that they can actually kind of solve those pain points using our platform and do it, kind of from their laptop or from their phone?
Hey, Frontier family. If you're finding value in today's episode, then Nathan and I want to tell you about a Facebook and LinkedIn community we're trying to grow of like-minded entrepreneurs who want to learn more to earn more. We share and discuss relevant topics, strategies, ideas, and overall ways to grow your net worth. So if you're interested in learning more, check down in the description of this video or this podcast to find the links to those pages. All right, let's get back into it. And does a lot of that struggle possibly come from just the markets they're involved in, like whether it be service-based or whether restaurant or light manufacturing? Is it because there's so much they're worrying about day to day because they're boots on the ground? And to your point, it's something that they've never dealt with. Like they're so worried about making sure, to your point, the pizzas get ready. Yeah. Hey man, I'm 60. you don't have time for that. Is that a lot of what you're seeing?
What I tell people is the biggest challenge outside of they don't know what to do is kind of fear and procrastination. And what I mean by that is we all procrastinate. Like, no one likes to prepare their files for doing their tax return. I mean, there's just stuff that, we don't like doing. Um, in an exit, especially if you're maybe 10, 20 years from retirement, an exit may seem like it's just too far away to even think about it, much less do anything about it. So what we find is people just kind of say, well, I don't know what to do there. I really don't have anything that's pushing me to go do this. So I'm just going to kind of kick the can down the road. And that is to their detriment. So that kind of uncertainty drives procrastination. And that unfortunately puts people in a position that if they suddenly have an event that forces them to sell, they're kind of behind the eight ball.
And so with some of that backing and recognizing that, hey, there's a lot ahead of me, right? If I'm starting today, and again, I'm not necessarily worried about the exit, but a lot of what we've talked about previously is how important it is to at least be thinking about it, having the background, to making sure that you're building that right business. So how early in your mind, based off your experience, should a small business or like a side hustle kind of start planning that exit? And what are kind of their first steps to your point of even preparing the right documents?
So, look, the pithy answer is you want people to start thinking about it from day one. That's great. People don't, and I understand that. This is a little bit like retirement planning. When you're young, you're like, I can put a little money away, but I'm not worried about it. I want to go on this ski trip. I want to go buy this new car, whatever it may be. But one thing is certain, 100% of business owners are going to exit. Father Time remains undefeated. So unless you have the magic elixir for immortality, you will eventually exit your business in one way or another. I think practically speaking, I'd like to see people have, 2 to 3 years. And here's the reason. Your business is probably not ready to sell. And so what do you need to think about on day one? You need to think about building a business that doesn't have a massive owner dependency. And that is one of the harder things, especially for people who are in certain businesses that are very relationship driven. It may be selling insurance. It may be in legal, maybe even other things. Is that owner is the business. And so they may have a great business that provides an extraordinary, lifestyle, and they make a ton of money. And they're like, why wouldn't somebody want to take this over? And you're like, well, when Lisa, who's the owner of this business, leaves, you can't swap Drew in and have everybody assume that they're going to stay with that entity. You may be wonderful and smart, but they're like, well, look, I was so dependent on her. Early on, it would be great to prepare documents and these other things. It's not going to happen. We want to do that maybe 1 or 2 years in advance, ideally. But as you're building the business, the two things you can do to better position yourself is one, make sure you're building a business that isn't, 100% involved on that owner. And two is just keep your financials clean, separate your personal and your business expenses, and make sure that you're using, maybe a professional, hopefully on a month-to-month or quarter-to-quarter basis, but at least on an annual basis to review things, make sure everything is good, submit your tax return, and make sure your financials are clean.
Absolutely. And I know we keep talking like, hey, the right direction to go and to make things look great, start here. But just not necessarily as a scare tactic, but just to recognize what happens when we don't, right? A lot of what happens when you don't prepare this, essentially at the end of the day, all you have is the assets. You're just selling off the assets you have, right? What, from your experience and the times that's happened to you, what is someone typically going through in that hard conversation of, hey, that's all we have is these items to work with? Just kind of give us an idea of what that looks like.
It's a hard thing because some people, and it is true, and I think probably a lot of your listeners will assume this, is there's a huge emotional attachment oftentimes for somebody who's built up a business. And yeah, I mean, like one of the challenges that we have from a marketing perspective is you don't want to come in and you don't want your marketing messaging to be, you're going to screw this up unless you use us. You're going to fail if you don't do these things. Even if it's true, it's not what people want to hear. It's not exactly a compelling message. So that from a go-to-market perspective is always a bit challenging. That being said, there's a couple of, I don't know if they're myths, but there's things that I've learned that are consistent, having seen thousands of people go to our platform, having talked to hundreds, if not thousands of small business owners. One is, even though they're older, they're generally speaking, most of them are more technically adept than I think people give them credit for. Two is, there's an emotional attachment, but eventually when they have trust in a third party opinion and information they feel is objective, it does wonders for level setting their expectations. Now, that may be because we're at an end of the market. We're dealing with people who have 6 and 7 figure, digit valuations. So I think they may have a little more practical sense of this. We don't have people who are generating, $850,000 in gross revenue thinking their business is worth $10 million. I've yet to see that. But, so we're servicing generally owner-operated businesses that may have anywhere from 2 to 10 employees. So I do think that they actually have a pretty good grasp on what they think their business is worth. That being said, to your point, they get into discussions and oftentimes they're not necessarily aware of the difference between selling just the assets and selling the business. It doesn't take long to educate them on that, but it oftentimes is a point of confusion as they start to engage prospective buyers as to, what exactly are they selling?
And walk us through, if you could, just kind of a real world example, maybe more so, of just a simple one to walk through. Hey, here's what we got to do at the end of the day with just the assets versus actually selling the business behind it. Just again, to paint the picture.
Sure. So, these aren't national brands, so I can talk about clients without using the name. We've got, one with a flight school in Panama City, Florida. Now they own 2 small aircraft that are, high quality aircraft that they've done the engine overhaul and all the other things. I'm not an aviation guy, but the investment they've made in those assets means that whoever would buy the business or the assets would come in and they don't have to necessarily invest a whole bunch of capital just to kind of maintain the business and keep it going. However, the owner is largely he's a retired former commercial pilot. So, he does these lessons. So, here you have a situation where you've got assets that are material, right? These are a couple $100,000 a piece. But as far as the revenue generated from the, flight lessons, well, this guy's no longer out there. So unless somebody else is willing to step in and teach that in that local airport, wherever it may be, they may just say, look, I live 500 miles away. I've got my own personal fleet. I've got my own flight school. I just want to buy the assets. So in one case, someone could come in and say, look, I'm 100 miles away. I want to expand my flight school. I'm going to pick up your planes and your customer base. So I'll put a value on the whole business and willing to take on assets and liabilities and buy the business and take it over. The other may say, look, man, I'm interested in your 2 planes, but the rest of it, I don't see any value on it. I don't want to legally have any obligation to service any liabilities within the entity. And I'm not going to pay for it, but I will buy your planes. And so in that case, what's happening is the buyer is going to pay the business for those 2 assets. It's going to put money, in the bank account of the business. But what you'll have is that legal entity. So the owner, the seller, is simply taking the money. They're going to pay down all liabilities. If there's money left over, which in this case there absolutely will be, the owner can pocket that, and then they need to go through what's known as a dissolution process. And that's a different thing. It's still, quite frankly, it's a good outcome. But, on another, we've got somebody who owns a couple of wax salons in New Orleans. Well, those are fixed retail locations. There's brand recognition. There's community. There's probably not a whole lot of heavy assets there. I mean, you could buy supplies and material, but really you're relying on, a customer base that has, developed and been consistent over a couple of years. So those are softer things. Somebody's going to want to buy the business itself because what they want is they want that retail location. They want that customer base. They just want to grow it. So they're buying the business. People have a clear idea coming in. Some people need to end up with an asset purchase. In not every asset purchase is going to work out favorably, but if you can get out of your business, if you're in a difficult situation, if you can get out, dissolve it, and either break even or have a little bit of money left over, that's still a win and it's still an exit.
Yes, sir. Yeah, it's not, and hope I didn't convey the previous as necessarily a negative approach. Just to recognize the hey, there's 2 approaches to this. Both can still be beneficial, but be aware that if you're still not doing it right, it can actually be the opposite. So no, I definitely appreciate that.
And I think I really reiterate that because sometimes someone will say, well, I don't know, you catch people sometimes in a state of vulnerability, which I really appreciate. Nothing fills my cup more than sometimes getting, off of one of our coaching calls with a business owner who may come in and say, like, I don't know what I'm doing. I'm not sure my business is worth anything. And kind of explaining to them, hold on, you have options here. And let's look at the financials. Let's look at the business. Let's talk this through. And then say, hey, look, I'm pleased to tell you, you're 100% wrong. And, in the case of the guy in Panama City, Florida, he had a reasonably good idea. I don't know he necessarily knew the difference in the 2 deal structures, but he came in thinking, well, I'm not sure. And how am I going to go about doing this? Well, what he saw is, hey, look, someone may want to buy it. And there's flight schools within his area that may want to take on the whole business. But even if he isn't, there's websites where he can sell those assets because there are communities and these people who might be looking for those planes specifically. So he kind of came in like, I'm not even sure if I've got something here and how this is going to work to, hey, look, I got a couple of options. Let me take both and see which one works out best for me.
And keeping with that idea of like finding value, if not increasing your value, right? What are some of the key steps now that business owners should really be taking? To your point, that's why at the jump, hey, 2, 3, 5, 10 years in, how are we staying on top of still being attractive to buyers? Like, are there still some key items to, hey, keep that on the front of your brain?
So cash flow and profitability, cash flow and profitability, cash flow and profitability. Now, what do I mean by that? So it is smart, it is legal to have a lot of expenses run through your business to reduce your tax liability. Completely, and I'm not a CPA, I'm not an attorney, so all the caveats that go with that, the disclaimer can come at the end of the podcast. But what you want to look at is, okay, if I'm taking discretionary expenses as deductions, these could be health club memberships. This could be maybe you've got, other services, car leases that you're running through your business that are reducing that. Now, it may mean your salary, quote unquote, is not as high as it could be, but you're taking other expenses that are legitimate business expenses that are effectively part of the overall income of being that owner. So the important thing is, it doesn't mean don't do it. It just means track it. So this is where clean financials make all the difference in the world. When somebody blends their personal and professional finances and it becomes a habit, that is where you're going to create a huge mess. And there's going to have to either be an investment in pulling that all apart, or, it's just going to create a problem to actually getting a deal done. Now, if you're from day one, keeping clean financials, so what that means is have a professional set up what's known as your general ledger. And it's just how to categorize expenses. If you want to do this on your own, you know how to do it on your own, awesome. My recommendation is that a good bookkeeper who uses QuickBooks or Xero or other systems can come in and set up a general ledger and leave to you to then, when an expense comes in or revenue comes in or expense goes out, you're categorizing these things correctly. And then they can check in this, once a month, once a quarter, once a year. Here's what that's going to do for you. It's going to give someone the ability to measure the potential cash flow and current cash flow of your business. They're going to say, hey, look, I might be taking an $85,000 a year salary, but there's really another $30,000 or $40,000 a year in discretionary expenses. So in practicality, a new owner could come in and say, well, I want to take $110,000 salary. And what I'm going to do is I'm going to reduce some of these discretionary expenses that I don't see a need for, but the previous owner did. And so as long as somebody can clearly see that those levers are things that they can pull, then you're in good shape. So it's really about keeping clean financials and a focus on profitability and discretionary expenses as you grow your business.
And how much of the process is in place value? Are they valued at the same level where it's like a direct correlation of, hey, I can pull this lever, get more money here, or how much of that process really is shown as value to a potential buyer?
Yeah, so there's different ways to calculate valuation. For us, we generally look at two, but one method is known as a seller's discretionary earnings, which is kind of what I just explained, which is how much cash can I as the new owner take out of the business? Total compensation. So benefits, discretionary earnings, as well as the salary that I'm taking. The other is what's known as a market base, meaning there are third-party data sets out there. What we do is we look at those and we say, okay, you're a HVAC business, you get a business classification code. If you own a business, this is the NICS code or the business code that shows up in the tax return. And it says, okay, using that code, how many businesses with that code with similar financials have gone through a transaction over the past 5-10 years? And we look at that data and then we take a multiple of gross revenue, we take a multiple of profitability, and then we take a multiple of EBITDA, seller's discretionary earnings. And so those multiples are relatively set. So if you want to increase your value, what you need to do is, if it's going to be, I'm making this up, let's just say it's 1.5 EBITDA. So for ease of discussion, profitability. So a business that has revenue of $1 million, 300,000 of that is profit. If it's 1.5 times 300,000, you get your number. Now, if you can, on that same revenue line, let's just maybe say it's $1 million, maybe $1,050,000 or $1.1 million, get to $400,000 in profit or $450,000 in profit, what you're starting to see is now you're kind of, even though the revenue necessarily don't grow at the top line, if your profitability is actually increased, now that multiple applied to a bigger number is actually increasing the valuation of the business. What people are looking for is, the craziest, easiest example is two businesses line up. They both have $3 million in revenue. One has profit of $100,000. One has profit of $300,000. Which one do you want to buy? No, it's not a trick question, but depending on the industry, so depending on the way the business is run, you can have two businesses that on the very, very high level look very similar in terms of their financials, but when you start to get into the profitability and the cash flow, they may be very different. And then you kind of say, okay, why is it that they're so different? Is it because the business just isn't fully optimized and efficient and could be? Is it because of market conditions, or is it because of the industry? And generally speaking, it's some combination of all those.
So when you're presenting the business, you wouldn't so much upfront discuss the process. It more so just reflects in your numbers. And then maybe you have a chance in the back and discuss, hey, we think we're doing this better in profitability because of XYZ.
Well, you bring up a great point. So when someone comes to their dashboard, what are they doing? And they're effectively doing two or three things. One is they're organizing documents, lease agreements, employment agreements, vendor and customer agreements, all those other things that are going to be part of the due diligence process. So those need to get uploaded into what's known as a data room, and we're walking people through that. Then two is that they're giving us their financial information through P&Ls, statements, balance sheet, and other things. The third thing that they're doing is they're writing narratives. And so, this isn't, looking at a stock like on your phone and saying, okay, is Amazon up, X% today or whatever it may be, and you just kind of look at a couple of numbers. The narrative is really telling the story behind the history of the business, telling the story as to why this business opportunity is interesting, unique. It is explaining why the financials are there. So when somebody enters this information into their dashboard, all this stuff gets, I'm going to use a highly technical term, munged together, and it generates a package for them to share with prospective buyers. And so a prospective buyer may be looking at these numbers. You don't want to make a business decision solely on that. So someone may say, hey, look, due to market conditions, we, let go of 2 employees. I took over as owner, but, now the economy has turned around. We can do these things. Now it tells somebody, okay, now I understand why they made the decisions that they did, and profitability may have decreased, but I'm seeing an upward trend toward profitability, for the future. And if I get in this situation again, I now know what to do. So it's really important. And there's no reason why any business owner in their right mind should actually understand and why they need to do all this stuff on the front end. And that's why we make it super clear and easy for them to kind of say, like, look, you need to do these things, but there is a story behind the numbers. Now, they got to match. I don't know that I've found anybody who's tried to really shine up something, and overstate this. Most people, these are people who've run these businesses, they have a pretty good sense of it. It's really just giving them the encouragement and the structure to do more than just say, well, revenue was down last year. Okay, why? So it's important to have these narratives along with the financial information.
And keeping with that narrative too, in that a lot of businesses are looking for companies that don't have massive owner dependency. How are you, one, displaying that? But then two, do you have any recommended tips for hey, if you're in that position, if you find yourself as a massive owner dependent in a company that you're maybe just looking to see just evaluation in, any tips for them to hey, I would take these 2 steps and see how it plays out for you?
There's 2 things that they can do. And one of the things that we offer is we do paid coaching sessions. So if people get stuck, they can book a one-off session with a coach. And that could be somebody for tax. It could be somebody for maybe just a quick legal call. It could be somebody who's just on the overall process. Sometimes those calls may lead to somebody who says, I thought I would sell my business for $600,000. You're telling me it's worth $400,000. I need to do some things to reduce owner dependency and increase profitability. That is not necessarily at that point, an exit plan. The exit process has actually informed you that you need to make some changes. And you may, and again, we can make these referrals. You may want to work with somebody who can say, okay, let me look at your business and figure out where are systems, operations, and structure that we can put in place, both from maybe software and systems, or maybe delegating to certain people, fractional executives, other people who can come into the business and take on responsibility so we decrease that owner dependency. That's why I always like to tell people, if you're doing this, 1 or 2 years in advance, you're in much better shape because now you know what you need to do to hit your goal versus, the analogy I draw is what you don't want to do is, at age 58, walk into an advisor's office and say, I think I'm going to ready to retire in 2 or 3 years. What should I do? So, the answer is you should have done something a long time ago. So, understanding, where your business is today and where you want it to be when you sell it, you need to have a pathway and a plan for it.
And now I kind of do like a quick 180, right? We've talked a lot about, hey, building your business from the ground up and making sure you're prepared for future goals. But a conversation we previously had that I love is, okay, and you mentioned it a little bit today actually already, insights for the next generation of entrepreneurs to be buyers, right? And the opportunity that they have to kind of acquire some of those businesses already and run with them themselves. Just starting off, I guess, basic there, based off the companies that are coming through your door, what industries or type of businesses do you see have the most potential for successful exits into these next generation of entrepreneurs?
Yeah, let me give you my pitch for those under the age of 30. So I have a 24 and a 26-year-old kids. And, as I look at their generation, so much has changed just from I'm Gen X. So just from my generation. And I think the questioning of, do I want to go work for a big corporate entity is great. Forget about why, the reasoning, motivation, there's emotional and other things that people can talk about. I don't want to get into any of that, but I think it's a good thing. These businesses that we work with, small Main Street businesses, are a massive part of our economy. They're least likely to be disrupted by AI, but they can operationally improve their business using AI. And they tend to be more stable in terms of their revenue and their longevity. I mean, look, I grew up in tech. I've been doing early stage tech for 30 years. I started at a tech company in 1995, and that's all I've done. That industry is it's super volatile. Whereas, the opportunity for this generation is, my generation is actually, statistically speaking, small. So as these boomers are aging out, it's not like the need for these businesses in the most cases is going to go away. This isn't email marketing automation where somebody's going to quickly fill the gap, and that could be a company out of Croatia. I mean, look, if it's a towing service, if it's asphalt repaving, if it's, you're making parts for, small light manufacturing companies, those aren't going anywhere. So the opportunity for the next generation has really become less dependent on a university degree, although I'm in no way suggesting someone not go through university. Two is that they're not subject to the kind of volatility of the tech market. And there is generally speaking, a much deeper involvement in the community, which I think a lot of people in your generation are looking for, and I think is awesome. I'm going to give one plug, even though it's semi-related, but not totally related to this question. I would tell for any age, but for anyone who is kind of quasi-interested in this space and younger, go join your Chamber of Commerce. It is, now there's thousands of chapters, so I can't say every one of them is great, but go check it out. Go to some events, pay the $100 or whatever it is to be a part of the chamber. If you want to get more dialed into your local community, the local business community, and meet with those owners who will be aging out and get to know them and get to know their businesses, your chamber is sitting right there outside your doorstep, and you should take advantage of it.
It kind of goes into the same idea of even the exit previously, right? The exit strategy, whether it be a merger and acquisition or selling to an employee. It could be selling to a friend, selling to somebody that they met. Hey, this is a solid young gentleman or young lady growing up. I'm going to talk to them, right? So just another opportunity to network and find those undervalued businesses. I love that.
Yeah. And look, having come out of Silicon Valley, I get the people who are like, I have conversations around our offering who'll say, here's how I'm doing my search and these other things. And they'll spend hours and hours on scripts that can scrape websites so they can email more owners and make more phone calls, and they're grinding. I'm like, look, I'm not saying don't do that. But keep in mind, as this space is really heated up, you're competing against search funds, people who've raised money to go buy these businesses, micro PE firms, other things. Automating and scaling your outreach is fine, but it's, oftentimes these businesses at this level are very relationship driven. There isn't a broker involved. There isn't an M&A advisor involved who has a network of people. And Generally speaking, people don't want to hand their business over to someone that they think is going to drive it into the ground, or quite frankly, they just think is a jerk and not going to treat their employees and customers and vendors the way they do. 50% of owners who come to our platform already know who's going to buy their business. And that is largely, it's not family at the top of that list. It's employee, it's business partner, then it's family, and then it's someone in their local community. So, there is a trusted handoff. And if you're trying to figure out and say, hey, look, I'm young, I'm 28, I don't have that much capital, how would I go about doing this? There's different ways, whether it's full-time or on a part-time basis, to work inside some of these businesses and learn them. And it's a try before you buy on both ends, where the owner gets to know you, you get to know the owner, and you get to know the business. And then you can say, look, I know how to run this business. I can make the improvements. There's a pretty good chance that these deals are going to be owner financed, meaning you're going to agree to buy the business and you're going to pay back, the cost of the business plus interest over a 5-year period from proceeds of the business. Now, the owner's going to want to know that they're going to get their money back, because they're going to have to wait 5 or 6 years perhaps. So if they feel like that not only you're capable, but they trust you, and they feel like if they need to step in and be of assistance, that you're going to welcome it. And so having those relationships in place, you don't get them overnight, and you certainly don't get them through a bunch of emails that you've automated and done outreach on. Just, been, again, working in tech for a long time. I mean, an email is only going to get you so far in terms of getting a deal done. It's going to be really hard to get that owner on the phone, so still do it. And there's part of that's part of the grind, but if you're in your local community, part of the reason I also encourage this is just not enough people take this advice and do it. And so, if you're thinking, well, I'll show up and aren't there a bunch of 27, 28-year-old people walking around, be like, no, generally speaking, no, you'd be the young person in there in a room full of, 45 to 75-year-old people who are running business and owning them. And if you suddenly start becoming somebody who they view and trust and think is smart and honest and capable, you got a huge advantage.
And I'm curious too, kind of on the backside, like, how do you validate their business ideas? Like, because no different, everyone can kind of have a business that stays alive while they're in there. So from an outside perspective, kind of maybe looking to companies, hey, who could I kind of maybe one day help and one day acquire their company? How are you determining then up front whether that business is worth buying or kind of walking away? Like, is there kind of like a quick tell to any of that?
Well, I think the honest answer is it's subjective. I heard this when I started this, and I still hear this for people who, when they say, what do you do and how does ExitGuide work? And the two things that I think people, immediately jump to is, oh, so you help them find the buyer. And as I explained earlier, no, we don't. And there's reasons we don't do that, but there's also reasons that we focus on what we do because of this huge failure rate before they even get it to market or, get to the time of trying to actually go and find a buyer. But, what you're looking at is we have a sale readiness score in the dashboard, just kind of shows, hey, look, have you uploaded the information? Have you answered the questions? Have you done the things to, now it's totally possible that somebody could package up a business that quite frankly is not very attractive, and they packaged it correctly. It's really hard for us to make that assessment, just other than to say, like, you've done what you need to do to package this thing up. As we scale and as we get more, I mean, when you get tens of thousands, hundreds of thousands of people onto a platform like this, being able to do some interesting things with machine learning to give predictability about whether you actually can get a deal done or not is all viable. Technically, we can do it. But you do have to start with something that gives people a sense. Now, the other point I want to make is, I do hear from people, they'll say, well, some of these businesses just aren't worth buying. You're just buying a job. There's a lot of people who are okay with that. I'm not the judge. So not everybody is thinking of this saying, I'm going to buy this pool cleaning business because I think I can 4x EBITDA and increase the valuation. Everybody's thinking about it as a pinhead MBA. There's people who are like, look, man, I've been the manager in this business for the past 7 years. I make $85,000 a year, and I can buy this business and take on a bigger salary. And, I can build this business up at 10% just by running the business. And then I'll have an outcome. So not everybody is looking at this as somebody who's a tech, refugee going in and trying to buy this business based on unit economics and EBITDA and these other things. They're saying, look, this is how I make my living. I'm in, Springfield, Illinois, and everybody knows me. And now that I'm the new owner, it's going to work out great. And from a banking finance perspective, people may shake their head. It's none of your business. These people, like the owner wants to sell it to Joe. Joe wants to buy the business. Is Joe buying a job? Probably, but it's a fair deal and Joe's going to keep his job. And so are 4 other people and they're going to still be a part of the community. I love that story. I think we should actually be 1000% supportive of helping people make that actually happen.
I think it's funny too, you have the banking, because it's almost like, well, it depends on the mindset of the bank. If it's a local bank, they love it, right? If we're worried about the national banks and the guys who are making money on the money they already had, yeah, sure, they may not like it. But
well, you bring up an interesting point. I actually asked this guy who's a pretty successful SBA broker who's built a huge following on Twitter. So Matthias, I can't remember Matthias' last name, but Pioneer Capital Advisors, great guy. And I asked him one time, I said, what is it that you look for when you're trying to assess a potential buyer? And at the top of that list was, do they know the business? And so I could line up a Stanford MBA who's going to come in and say, I want to buy 3 pool cleaning businesses in Southern Illinois, and here's what I want to do, and here's my thesis. And he's got, $150,000 of capital put down. Well, then there's the employee who may say, look, I could put down 10 grand, but I've been working in this business. Every customer knows me. Every vendor knows me. If you're the SBA lender, you're thinking about mitigating risk. Banks are not investors. Venture capitalists are investors, and they're buying forward-looking opportunity and blue sky, and they know some of these things are going to hit, and they're looking for an increase in value. The bank is saying, like, I don't care if your revenue is flat. I don't care if your revenue grows 3x. As long as I'm getting paid my principal plus interest, I'm worried about failure rate of these loans. So if you pay your bills, I want to make sure that those bills include me, and I'm more likely going to go for someone who's already consistently proven that they can run this business than somebody who is just simply trying to maximize value, because the bank doesn't see, if you 10x this thing, the bank doesn't see any value from that increase in valuation. It'd be great if you did. You might do other things with the bank, but what they're looking for is really just pay back my damn loan.
No, I love it, man. To that point, a lot of these businesses are very much in that local market, right? To your point, it's the customers, it's the employees, everybody's involved locally. And so they're not necessarily looking for the outside money, right? To your point, the market cap is 5 million, and then most of those are less than $1 million. So really it's kind of it's a world that you got to get involved in. And to your point, and I just kind of want to touch on it for a minute too, because like I follow people like Alex Hermosi who do talk about, hey man, you got a 5x, 10x, and that's all great. That's what you want to do. It really is great. He has a lot of great stuff out there. But I always find it funny too. You dig into the comments and you find some local guy, hey, I'm a photographer, I do whatever. And it's kind of a little bit of an argument, but they say, hey, I'm okay with $200,000. Yeah, I run my business. I have a couple employees, but I can go home at the end of the day and not be stressing about how I got to wake up tomorrow and in a month prove that I 2x'd to whoever. So no, I think you're 100% right. It's like, it all depends on what the buyer at the end of the day wants and how successful is it going to be. And I think at the end of the day, as long as you align with the perspective, you're good to go.
Yeah, I think your point is really important to reiterate. I'm going to make a business reference here. In the movie Caddyshack, I'm assuming everybody has seen this. The judge walks into the pro shop. He's wearing this funny hat. And Rodney Dangerfield is making fun of the hat on the display. And he says, looks at the judge and says, oh, but it looks good on you. Here's the point of the story. That's fine. Like your point. Alex is great stuff, but that is looks good on you. Like, you don't have to go do that. You don't need 6-pack abs. You don't need to be an influencer. You don't need to do 5x of increasing your value if that's not your thing. And if somebody else wants to do it, great. That hat looks good on them. Let them go do that. The other point of this locality is one of the interesting things when I started to look at it, that not to knock another business, but a lot of instinct just because of brand recognition is people think, well, I'm just going to sell my business, so I'm going to put the business on biz buy sell. Think about what you're doing. One is, are you promoting your business before you're ready to sell it? Like, are you even really ready to engage back to the buyer? Like, have you priced this? Have you packaged it? And these other things. Bringing people to your doorstep when you're not ready and you don't have this information and you haven't done things correctly, all you're doing is inviting failure. So that's the first thing. Is if you just take that step and you skip everything else, it's not going to work. 2 is, well, if you have that pool cleaning company in Springfield, Illinois, do you want to pay for eyeballs that are in Seattle and California and Wyoming and Florida? And like, I mean, what are the odds that somebody who's sitting in Buffalo, New York is like, well, we'd move to Springfield as long as we could find a business to buy. I mean, that's just not happening. So, your buyer's probably going to come, depending on where you're located, a few dozen miles of where the business is located. So if you don't know who that buyer is, meaning it's not a family or someone in your community or an employee, then it is probably going to be somebody who's relatively close, especially if it's a service-based business or has a huge service component.
And I love that too, because we're getting a little bit like larger view on it all. I love it because that's kind of where I want to end it, right? You've seen a lot of business across the U.S., whether it was stuff that you were personally involved in or that you're working now through your company. Um, whether it be advice we talked about today or we haven't, is there like one major piece of advice you kind of want to leave someone with, whether they're looking to acquire a business for themselves for the first time, or they're looking to exit or looking to plan to exit? What's like, hey, at the end of the day, gotta have this.
Yeah, I mean, I think the important things, if you're, whether you're thinking about or know you'll eventually sell a business, is just start educating yourself. We've got a contact at ExitGuide.com. We have articles. There's plenty of stuff on YouTube. I'd love for you to read our stuff and view our content, but there's just plenty of stuff that's out there. Just don't get into the whole, like you said, influencer nonsense of you got to 10x this and you got to do that, and you'll be taller, faster, stronger. Just educate yourself about the process. What is a business valuation? How do you increase valuation? ChatGPT. There's tons of tools that are out there. Few minutes here and there will actually make you a little bit smarter, a little bit more confident. So start to educate yourself. 2 is what I mentioned earlier. Keep your financials clean. If you're not sure, then maybe enlist some professional help. And then also make sure that you're tracking those discretionary expenses. Now you know the levers of your business. If you're looking to find a business to buy, yes, you can sit in front of a laptop and start to do a fair amount of work on that. I think the mistake that I hope people in Gen Z avoid is get out there, go to events, get involved in your local community. Chamber of Commerce is one, Rotary clubs are another. Sometimes there's faith-based organizations. There's just stuff out there. And the people that you're going to actually try to engage your prospective buyers, that's where they are. Yes, some of them are indeed on Twitter, but the 68-year-old guy who's been running a pest control business with 15 trucks, he doesn't know who the hell Cody Sanchez and Alex Hormsey are, nor does he care. And if you come in and say, I just did this program and I want to talk to you, but if you're showing up at that event and you're drinking tea or a cold beer with that guy and you're asking questions about your business because you're at the ribbon cutting for, his buddy's, new factory, you're building the right relationships. So if you want to be on the buy side, just get out there, start meeting people.
I love it. And to that point, clearly, those 20 years plus at this point really shines through, right? There's a ton of knowledge experience behind you. So I wish we had more time to dive into this, but taking someone then from where they're at today, maybe they're in their seat of their car or they're listening to while they're jogging or something. Do you have any education items or things for them to follow up with? Obviously, ExitGuide.com. It's like a great resource. We'll definitely follow up and plug that down below for anyone to see that. But were there any impactful books or people that you had along the way that you would recommend to them as well?
That's a good question. And I think the answer is, I'll admit, I'm a voracious reader who never reads business books. And I'm not suggesting don't read business books. That's not my point. And if you want book recommendations on science fiction and historical fiction and fiction books, we can do a whole nother podcast on that. What I found was the way I learn is, yes, I'll do some online reading and research, but I benefit from going out and talking to people and just, buying people a cup of coffee, getting to events and doing other things. So I probably lean more to that. I mean, obviously I'm telling people, get out from behind your computer and go and meet people. I joined the local chamber when we moved to Austin. Part of it was I wanted to know more about my community. Part of it was to kind of know your customer type experience. And, I don't know what I was expecting because I really didn't have an expectation coming in, but I came out of it thinking there's so many smart, awesome people who are involved in the chamber running these businesses around. I actually like going into sometimes where I go into a business and it's somebody that I know from the chamber and they're like, hey, Eric, it's good to see you. What's going on? How's your wife? What's happening here? And it brings me closer into that community. But I understand who these people are. I understand how they get their businesses. Where do they show up? Where do they build relationships for banking and tax and other things? And how do they help each other out? It's really difficult to get that from a book. So my own personal bias is toward getting out there and being actively engaged. And I understand not everybody is comfortable with that and being extroverted. So maybe you don't need to do it to the degree that I'm saying, but I will tell you do need to do it. You are not going to buy a business by reading some books and the Harvard Business Review stuff and following some people online and then just doing this all for your laptop. If it does happen, you are catching lightning in a bottle. If it works for you, then awesome. but is the equivalent of saying, I'm going to drop out of college because Bill Gates and Mark Zuckerberg dropped out of college. You're like, I mean, sure, but that don't mean you're going to go become a multi-billionaire by building a company, because there's a lot of other people who finished their degrees and worked in their fields and became relatively successful. So don't use the exception to the rule as your data point. Use the kind of more what's happened in the practicality of your what's around you.
Yes, sir. Yes, sir. And keeping with that, if they wanted to reach out to you, maybe have a conversation with you or buy you a cup of coffee, is there a way they can get a hold of you outside of the Exit Guide platform?
Yeah. So you can just email me directly, Eric with a C at exitguide.com. I'm on LinkedIn. I'm on Twitter. I'm pretty easy to find as long as you can get Grafstrom right. So it's Eric with a C. And Grafstrom's just like Nordstrom, but replace Nord with Graf. And I have no retail empire behind me. Kind of missed the wrong strum when it came to being born, but go Scandinavians, go Swedes. Yeah. Email me, Eric at exitguide.com, or find me on LinkedIn. I'm generally pretty available and do push out content related to Exit Guide and entrepreneurship.
Yes, sir. Yes, sir. And just like me, if anybody forgets how to spell that, I'll put it down in the description, bring those links, and people can find you there. So, Eric, we definitely appreciate it, sir. A ton of good stuff today. Again, I wish we could keep talking, but maybe we'll have you back on for another episode. But like I said, I definitely appreciate it, and I wish you the best, sir.
Thanks, Drew. Same to you.